Fundstrat's Tom Lee just dropped some pretty big bombshells on CNBC. Kind of gets roasted for being a little bit too bearish over the past 6 weeks or so, but in the bullishness that Tom Lee does bring, he says to be cautious of turbulence, that there can be bumps along the road of this soft landing and golden path that markets seem to be on. It does sound like Tom Lee is going to be a lot more bullish after this election is over with, but he does say within the next 2 weeks, you want to be a little defensive. And he does highlight one trade in particular that has worked out about 85% of the time that massively has outperformed the S&P 500 over the past 25 years. Take a listen to this clip. Let me know what you think about it afterwards down below in the comment section. Now, we are also going to speak about my recent turn to being a little bit more bullish. I will break down and clarify some details and questions that some of you guys have had, and we will look ahead to next week's events. Any economic data that we have, the earnings lineup that we have, and why we could still be in for a pretty bullish period in my personal opinion. It comes down to earnings expectations being massively lowered and the lack of economic data.
Let's bring in our market panel as we did set those new records for the Dow and S&P 500. Joining us, Fundstrat co-founder Tom Lee and Jefferies chief market strategist David Zervos. Both Tom and David are CNBC contributors. Guys, happy Friday. David, coming off that rates impact for the government there, what do you see coming for rates? How long will it take us to get to neutral? How will that affect stocks and fixed income from here?
Well, I think that is actually one of the biggest questions out there, not just for fixed income investors, but for equity investors. I think the speed with which we get to about 3.5 is probably pretty quick. It could be as fast as mid-year. And then I think the debate about neutral starts. And that could be a pretty kind of risky, bumpy, messy debate. I think a lot of people around the FOMC table have raised their neutral rate forecast. And as we've been writing at Jefferies for the last couple of months, we think that might be a pretty big mistake as the balance sheet contracts and gets back to a more neutral level. So I'm looking for actually rates to go back to 2019 levels eventually, which would be music to the ears of commercial real estate, private equity, and venture guys, and probably my friend Tom over there for equity multiples as well. But I think it might take a little while, and there's going to be a big debate as we go through 2025 and into 26.
All right. Well, Tom, speaking of equities, I'm going to do something rare, mostly because it's funny, and give you a hard time for not being bullish enough. 6 weeks ago, you warned about a potential 10% pullback in the S&P in the next 8 weeks. We're up 6.5%, I think, since then. Now, you did say to buy any dips if that were to happen, but do you see any more potential icebergs? What do you think got us this far?
Well, John, the stock market in the last 6 weeks has proven its character, which it's had all year. The S&P is incredibly strong this year. It's been up now 9 of 10 months. And you're right, we got fooled by seasonality because I figured, well, between now and election day, there's a heightened possibility of some type of correction. We weren't saying you want to sell stocks. I think it's always a mistake when people panic sell, because we, literally in the same paragraph, said, but if it does pull back, you want to buy that dip. And I think we're still in that tricky period until after election day. But that doesn't mean I think investors should be bearish right now. I think we have a really good fundamental backdrop. I mean, look, if David's view is correct, 3.5% 3.5% Fed funds rate is very supportive of the economy. It's going to really take housing and autos and durables out of a recession. And that should be good for not only earnings growth, but for PE multiples. So to me, all of this, I think, is a pretty good backdrop. That doesn't mean turbulence couldn't happen. So, John, I guess, I think people kind of view the idea that there could be caution as like a dirty word. It shouldn't be. I mean, this is a stock market, and people should be prepared to buy dips if there are.
Yeah, and we're coming into the 2 weeks of peak earnings season, Tom, to your point. Plus, right behind that, we do have this election. So the next couple of weeks will be ones to watch here for investors. You just mentioned housing, though, Tom, and I do want to get your call on that because you're bullish on the home builders, and you say there's historical precedent for this.
Yes. The reason we highlighted the trade today is that since 1999, believe it or not, there's a 6-month window when home builders enter a golden 6-month period. It's something we've been writing about at Fundstrat for a better part of a decade, and the trade's worked 12 of the last 15 years. But from October 20th to April 29th, home builders have outperformed the S&P by an average of almost 1,900 basis points. So all of the gains home builders make typically occur those 6 months. I can't explain the seasonality, but the backdrop is better today because the Fed is cutting at a time when there's pent-up demand, and the home builders have actually done a very good job of capital management. So to us, it looks like a trade that should work this year.
So I think Tom Lee is taking the approach of, yes, you want to be in this market. Yes, this is a bull market, but there will also be turbulence. This is the stock market. You do tend to see, at least looking at the average of our markets over the past 100 years, you tend to get about 3 corrections per year. Now, as of lately, we have not gotten that many corrections per year. In 2023, in fact, we got this was a pullback of about 9%. You got 1 correction there. If you look at this period, you got about 11%. That was 2 corrections in 2023. In 2024, you had, if we assume a correction's 10%, we had a 6% correction in 2024. Then we had almost a 10%, about a 10% correction in August, right? So really only 10% correction, really only 1 real correction in 2024, and then 5-6% correction or so, and then about a 4% correction in early September. We really haven't seen nearly as many corrections as we normally do. So yes, from that standpoint, I think Tom Lee is correct. We are vulnerable for a correction, and my stance on that has not changed. In the near term, I do think there will be growth scares. I do think there will be corrections, and I think we should be prepared for that. Having cash on the sidelines, being able to buy the dip makes a lot of sense to me. I think you don't want to be caught with your pants down, investing all of your money right here at all-time highs, and then we just go into a correction and you don't have any money left to buy. I think you want to be in a position to capitalize on that and to take advantage of any near-term weakness that we do get in markets. But as of lately, I've kind of changed my long-term stance on this market. Whether or not we go into a recession or not, I don't think we're going to get a prolonged period of downside. I think the Fed will act aggressively. I think the government will act aggressively if they have to pull us out of that situation. Now, at the same time, you have a lot of really passive investing. Every week, people are sending their money to their 401ks, and that money's being sent into the S&P 500 by and large. And the dynamics of this market have really changed from even, COVID or the, 2008 recession. It's very different in the sense of there's more money out there, there's more investors out there, and there's more of a reason to be invested in markets today. Now, inflation and the Fed really caused markets to be very turbulent in 2022. Inflation is a terrible thing. It rose the odds of a recession. The Fed was raising rates after rates had never been risen in like 25 years. It was the fastest, most aggressive pace of raising rates as well. So I think there was a lot of complacency in the sense of rates are not going high. Once Wall Street realized that rates are just going to keep rising until inflation is defeated, that really spooked a lot of Wall Street. And I think that did slow down contributions to 401ks. I think people really took a big reality check during 2022. Now that we've went through a pandemic, we've went through inflation, we went through the Fed raising rates, I don't think we're going to be surprised anymore via what we get. And I think Wall Street is a lot more resilient to these fear factors than we otherwise were before. Even think about the banking crisis in early 2023, right? That really didn't derail much of anything. Where in the past, that probably would have given you a 10, 15, 20% crash. We did not get that. And I think at this point, there are a lot of favorable things for markets over the next coming years. I think inflation in and of itself is going to help inflate markets even higher. Inflation does tend to and positively affect asset prices over time. And I think you have started to see some of that, but I think there's a lot more of that in the pipeline to go, especially if we do avoid a recession, which, yes, I still think there's a maybe 65% chance of a recession, 35% chance of a soft landing, but I don't think it's going to be a hard landing. And I think we won't know if we're actually going to get a soft landing or hard landing or not until at least April at the earliest of 2025. At least April at the earliest. If we can get to April of 2025, start to get March's economic data coming into us, and it's good, then I think the odds of a soft landing are going to jump dramatically at that point. But right now, I can't move the odds of a recession just based on nothing, okay? Now, I will acknowledge the areas of the markets that would be vulnerable to a recession, a shallow recession, are areas that have already priced that in. Small caps, mid caps, right? They've already priced in that recession risk. Cyclicals. Big tech has not. And I think with a shallow recession, big tech would price in some, lower earnings estimates or whatnot. But I think in a shallow recessionary environment, big tech would not price in that much, weakness from that, because Wall Street seems like they're not responsive to economic activity. So from that standpoint, could a shallow recession give us downside? Of course. 10, 15% downside? Yes. Would it even be 20% downside though? I don't think so. As long as it's something shallow that's not inducive of a huge spike in the unemployment rate. If it's just a more normalization, if you will, from a overly hot economy, I don't think that would need to be a multi-year downtrend and 20+% downside in the S&P. Now, the literal million-dollar question will be, does a shallow recession cause companies to pull back on AI investments? And so far, it doesn't look like there is any plans of pulling back on AI investments anytime soon. What did Google say last quarter? The risk is they don't invest enough. That's what Google said. The risk is they don't invest enough and miss out on the opportunity. And that far outweighs investing too much and losing too much money in the near term. That's what Google said. I mean, if AI proves to be something that Wall Street does not like, then we have a huge problem on our hands. But until that happens, I mean, when is that going to happen? 2 years from now? 5 years from now? 10 years from now? It's hard to say that with any degree of certainty, but it does not look like that moment is coming anytime soon, according to NVIDIA, that says demand is basically unlimited. So I'm not changing my stance on recession probabilities. I'm simply saying that if we do get a shallow recession, you're going to get the Fed massively cutting rates, an end to quantitative tightening. You're going to get the government that responds. In a shallow recessionary environment, I think those positives outweigh the negatives of a shallow recession. The Fed's going to act quickly, basically overnight, to accommodate things before shit really hits the fan. And markets tend to bottom and react positively to those things before we react to the bottom in the economy, right? In other words, during 2008, markets bottomed around March or so. Let's just double check and refresh. Let's see. Yeah, you got to go back so far now. Markets bottomed in March of 2009, but things did not get better in the economy then. Things did not get better in the economy until the end of 2010. Like, that's when things started to get a little bit better in the economy. People started to say, hey, maybe we're coming out of this. Maybe things are going to get better from here. And if you waited until then, the S&P had already risen from the bottom like 80%. Just ripped faces off of the bears. So that's kind of the same logic that I'm taking on this. By the time the Fed reacts, which would be pretty soon if we did start to look like we're heading into a recession, the markets would likely already go through its little crash event and recover. Now, that could happen relatively soon. That could happen within the next 5 to 6 months, and that's really what I'm looking out for. But if it does not happen within the next 5 to 6 months, then maybe this was actually just a rolling recession all along. Different areas have experienced the pain, and maybe things can start to slowly, yes, recover. But I do think it's far too soon to know that with any kind of certainty. And I think whether or not we go into a recession, I think you are due for a correction. So I think that is something we should be mindful of and be vigilant for. And honestly, a nice 10, 15% correction would be music to my ears at this point. A 15% correction will put you back to where you were in, April of 2024, like earlier this year. Really, that would not be a big deal in the grand scope of things. Now, one reason perhaps in the very near term, I'm not as bearish as perhaps I was. Sure, can there be a correction? Of course. But it's this earnings season, okay? So this earnings season, estimates have fallen so much, it is going to look like companies had a great Q3. When in all reality, the earnings estimates just went down. So there's now an easier bar to beat. There's going to be a lot more companies beating on earnings. That's going to help push markets even higher. And then after this earnings season, we're really not going to get the next earnings season until January, mid-January or so, early February. Like, by then, I think we'll have a better understanding of the economy. By then, I think the economy could be taking a little bit more precedence over even near-term company earnings, meaning if the unemployment rate continues to rise into February, I think markets are going to be paying more attention to the Fed and to the state of the economy. Now, if the unemployment rate does not rise, if the economy continues to do well, then I think earnings are going to be just fine. I don't think earnings at this point are going to be the thing that really takes down markets, because what happens when earnings start to come in on the weaker side? Analysts just lower estimates. So now the bar is easy for companies to beat. Like, that's it. If earnings season is going to be bad, like this earnings season is going to be, analysts just take down their estimates and make it easy for companies to beat. I mean, that's like rigging the game. You don't want to bet against a rigged game. You're going to lose every time. And that's essentially what earnings season is. It's a rigged game. If earnings estimates were where they were a month ago, companies would be missing left and right for this earnings season. But they're not going to. They're going to beat, and earnings are going to look great, because the bar is massively lower. And again, just to kind of give you a sense of this, you can see this is 2024 right here. Earnings estimates have been plummeting, falling off of a cliff for this year's earnings, for this quarter and for 2024 estimates. So even by Q4 estimates. So by the time we get to earnings January, early February of 2025, the earnings estimates have already plummeted, let alone if they fall even more heading into January and February. So the bar is just insanely low for the next 2 quarters. And that's why I think if we do get material downside in markets, it will be because of the economy. And my stance has really not changed. I never thought we were going to get an election correction. I've always been in the camp of the government is not going to let the economy fall out of bed right before the election. We could actually be in a bigger problem in November and December. As far as economic data, you might start to see economic data look like it is rapidly weakening, but in reality, it's just catching up to some of the maybe not so accurate numbers we got heading into the election. So yes, I'm still more concerned about November, December, January, February, March, but not really in terms of the next 2 quarters in earnings, but the economic data that we might start to get come in more accurate. We've seen via the non-farm payrolls, 750,000 government jobs were just added magically. Without that, the unemployment rate would have shot up and Wall Street would not be nearly as bullish as they are today. Coincidentally, it's right before the election in which that happened. Even last week's retail sales number, retail sales not adjusted, actually plummeted 7% month over month. But the seasonal adjustment took that to a positive number. We beat estimates for last month, even though we really didn't. So after the election is really when I'm expecting we could see a correction over the next 2 weeks or so. I think markets could continue to rally higher. We really don't have any economic data Monday, Tuesday, and Wednesday. Thursday, you have S&P Global Composite PMI flash, manufacturing PMIs, and services PMIs. You also have initial jobless claims, which are actually expected to rise a little bit, and Chicago Fed National Activity Index on Thursday. On Friday, you will get durable goods orders month over month. Estimates are negative 0.9%. So I think if anything, you could come in a little bit better than that. Again, right before the election, you don't want to have any economic uncertainties or worries. So again, I'm still keeping my recession odds where they are. I have not seen anything to really materially change them, but a shallow recession, Wall Street may not react to. I think you've already priced that in to the areas that would be sensitive to a shallow recession. So I'm not changing my recession call. I think still you want to be more defensive, ready for a correction, November, December, January, February, March. But if we get March's economic data, which we'll get in April, and it comes in good and things are fine, then one would naturally have to start lowering their recession forecast. That's my timeline. It's up in the air, in my opinion, whether or not we have a soft landing or recession from now until at least April of 2025. And I know that's just a long time, and Wall Street likes to jump to conclusions, and that's what's happening. I don't want to fight Wall Street jumping to conclusions that we're already going to experience a soft landing. That's a guarantee. When you have earnings estimates that have plummeted heading into the next 2 quarters of earnings, I can't be bearish into that. Now, internally, I can be bearish, but as far as positioning my portfolio, no. I mean, that would be stupid, right? And that's why I'm taking more of this bullish stance in the near term. Yes, we could get a correction. Forget that. In the near term, until we start to see economic data worsen, until we start to see, something else break, I think the market's animal spirits are just too strong to send this thing down in any kind of material way, more than a 10% correction. That should be expected at any time in any year. You tend to get 3 of them every year historically, but larger than that, it's hard to see. So let me know what you think about all of this information down below in the comment section. You guys have a fantastic rest of your day. Stay safe out there, and I will see you in the next one.